Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. I'm Paul Winkler. Evan is here with me right now. I will be back. You had to make a phone call. That's what happens when you're a busy executive, right?
That's right. The joys of live radio.
Exactly. Evan, you probably have an opinion on this. Financial aid form upending college decisions.
Oh, it could be. Yeah.
Students and families will have to complete an already stressful process. Boy, it's a really stressful. Putting that form together is really stressful.
I've already started getting some emails and texts from parents of, hey, this is going on. Do I include this in the FAFSA or so forth?
Yeah.
I mean, it is. It's a big deal.
There's a lot. It says that they have a stressful process and what college to attend under tighter deadlines and general or greater uncertainty than ever this year. The source of the heightened anxiety is a change by the education department intended to speed up lots of unintended consequences and simplify how families qualify for financial aid. Delays rolling out the revamped free application for federal student aid, or FAFSA, as it's normally referred to, meant to aid applications which normally begin in October, couldn't open until late December. Then technical glitches during the soft launch of the online form further exacerbated families and exasperated, I should say, families and schools. In the past, colleges, they would get the data from these forms. After the application was filed, information on the new form, they basically said wouldn't be available to the colleges until late January at the earliest, and that leaves a lot of financial aid offices unable to assist families until then. So, you're like trying to rush to get something done, and then you got even less time to deal with it.
Yeah, and there's a few things that are going to be at play. Number one, the formula had a change in terms of how they account. And I think we had talked about this some last year when that was first announced, but they're not going to give as much credit to having multiple students in college at the same time.
Oh.
And so people's expected family contribution, the EFC, that the FAFSA is designed to come up with that number of what the government says you're supposed to be able to pay for college. Yeah. That's going to be higher for some people unexpectedly, and now they're in a hurry. And
people's budgets are kind of crunched many times. You kind of have your budget set, and then all of a sudden you get a curveball thrown at you like that. Sure.
And you may not know, I was going to apply to this school, and now I maybe don't have enough dollar. I maybe can't get enough aid to go to that particular school. Yeah, they made a comment in this article. Yeah, they said students who applied to college early and have already been accepted by the school of their choice are facing a time crunch. They said they might not even get their full financial aid packages till March or later, which is after some colleges' early decision deadlines. Yeah.
What a frustration that would be.
Right.
Early decision applicants are generally committed to attend if they are accepted, though can back out if the family can't afford to pay. Early action applicants, like regular decision applicants, often have until May to make the decision. And, I think this is going to be a big topic this year.
Yeah. And the new system, if you file online, is, like you said, it's designed to streamline the process. And you end up giving it permission to basically access your tax records from the prior year. And, so some of that theoretically is more automated. But, you think about anytime you get a correction to your tax return, you've maybe gotten a postcard, postcard's a letter saying, hey, you forgot these dividends. You owe us $22 bucks or whatever.
And you have to refile.
And so now you can see, it kicks out. We need you to actually send us, fill out the information manually because we can't link to your, your record. it's going to be a challenge.
Yeah, I think it will be. Hey, you actually swerved into something that's an interesting topic in general that we probably ought to address this time of year. Is always something that people think about with non-qualified accounts.
Oh, yeah.
So you got your qualified accounts, you got your IRAs, you got your, technically they're not qualified, but we often refer to them as that because they act just like qualified plans like 401ks and 403bs. But you'll have non-qualified accounts, which is I want to put money away. And I have put what I can into an IRA. And if you're fortunate enough to have enough income where you actually are able to put money away for in your, let's say, 401k plan, your income is high enough and you're able to do that, max it out, no problems. So sometimes what happens, people with higher income, they're looking at, well, gosh, what do I do? Now I got to put money away and I've done everything I can in my 401k plan. Where can I put it? And I think non-qualified account. So the idea, because, being able to make further contributions to IRAs may be not, you don't have that ability because your income's too high for those types. And there are phase outs for that. Where your income is too high, you can't deduct the contribution. And a lot of times you look at putting money into a non-deductible IRA, it's a non-starter simply just because of the fact that you got to track all of those post-tax contributions in the future, and that can be a real pain in the neck. But, the other thing I like about non-qualified accounts is they're subject to a different type of tax rule, which is capital gains taxes versus regular income taxes when you pull money out. But then you got this little thing called dividends. And, I don't know about, and Ira's back from his phone call. I don't know about you guys, but I know that around this time of year, you'll get people that are in a big hurry to file their tax returns.
Yes.
And, they want to get them done as soon as possible. And I go, well, you got this non-qualified account and you got to be conscious of what Evan was just talking about. So describe that a little bit. What's going on with your tax returns and why it is that these companies that are filing and telling you that you've got income from your investments, they usually file extensions themselves.
Yeah, well, and some of it's one of these official communications from the service. But, if you're taking distributions from an IRA or those kind of things, or even W-2 if you're on salary, most of those documents all have to be delivered or sent by January 31st. Used to, your 1099 composite, that's the statement from your custodian that says, here's the capital gains I had, here's the transactions I had, or dividends in your stocks or mutual funds. That used to have to be sent by the 31st of January as well. But with all of the changes in the tax code over the years, they had this new category of qualified dividends. And so a company had to, meet a certain set of criteria, and those dividends are only taxed at 15%. Well, then, international companies may delay their reporting. And so what would happen many times, and when I was preparing returns, you'd get this thing filed, and then mid-March, you get a corrected 1099.
The frustration, yes.
And, hey, this was your dividend number, not what we sent you January 31st. So the IRS basically ended up just giving a grace period and said, okay, you don't have to send this stuff till the 15th of February to mitigate some of that. It still goes on.
Yeah, so these companies have a longer period of time.
They've got a longer time to get it to you.
And then you've gone and filed your taxes.
Right.
Only to find out that they come back and they correct, quote unquote, your dividend payouts from, especially international. You see that quite often, the international markets.
Yeah, and then, that's when you find out if you had a foreign tax credit, just all those kind of things. But here's the interesting thing, just thinking about, swerving into it in the first place. Oftentimes, people will get the form and in their mind, they'll say, okay, well, I didn't take anything out of this account this year, so I don't need to worry about putting this on my taxes. And you do. Even if those dividends were reinvested, even if the capital gains distributions were reinvested in your fund or even individual stock, if we're talking about dividends, just because you didn't take possession of it physically, it's still a taxable event, and you do need to make sure that you're reporting all of those transactions just so that you don't get any nasty grams from the service come June or July.
And when a portfolio is being managed, one of the things that happens is you'll have rebalancing the portfolio for risk because, think about it. If you had been an investor that had, and let me just use a broad example to make this really, really simple. From the 1960s to the early 1980s, just use as an example, international markets literally just trounced U.S. markets during the 1970s. They absolutely trounced U.S. markets in the 1980s. And to use a really simple example, can you imagine what your portfolio looks like? It's primarily international.
Yeah.
By the late 1980s, right? And I remember getting in this business and having these guys around me, these older guys that have been in the business a while, say, Paul, and they put their arm around me and they pat me on the back. Congratulations, getting your securities license. Don't mess around with U.S. stocks. Just put your clients in international. And there was a really good story to be told about how U.S. was going to continue to be dogged by international.
Yeah.
And then you go and you have this portfolio that you don't manage and you have all of this international exposure. In the 90s, we have that huge bull run of U.S. stocks and you're not there for it.
Yeah.
And you did it maybe because of tax reasons, because you didn't want to pay a little bit of capital gains taxes on some of the gains that you had incurred with international, and now you're kicking yourself.
Yep.
So, I think that's a really big deal, and that's going to be part of it when you're having an investment for it. And then also, let's say if you're dealing with portfolio and you got small companies that become medium-sized companies, they're sold out of the portfolio. You got little things that happen inside of a portfolio when it's being managed that trigger capital gains taxes.
Well, if you remember, Paul, and how difficult it was 1998, 1999 to keep clients difficult when they wanted to move out of international into U.S. It was the exact opposite of what was happening in the 1980s. Because I started in the business.
It's terrible.
I started in the business in 1984.
Yeah.
So I remember the international markets running. But then, when people are like, let's put more international into the portfolio.
Templeton was the big name,
Oh, yeah. Good point. Yeah, that's a name that you haven't heard really talked about in decades.
Yeah, well.
Really good point. That's interesting. That's a good one.
Once they were bought by Franklin, and then it became Franklin Templeton, and then Templeton went away.
Yeah, that's true, too. They did. When did that happen?
That happened in the 80s. If I remember correctly.
No. Franklin Templeton had been around longer than that. Franklin Templeton had been in the name for longer.
Templeton was an individual
fund
company.
When did Templeton go out of the name, though? This is trivia.
I don't remember.
This is trivia, and I would have lost this game. This round.
But the same thing that you saw, like with those older brokers saying, "Don't buy
Evan's
U.S.
gonna look it up.
Don't buy U.S. Just buy international." In the late 90s, it was like, "Get me out of international. Just put me in U.S." And then if you did that, the U.S. stock market dropped in 2000, and the international markets took off.
Yes.
So that's the importance of just staying disciplined and rebalancing the portfolio.
And not letting the tax tail wag the dog, as we like to say.
And that's what I was going to say.
All right. Evan's got an answer.
October 92.
Templeton's
name went away?
When Franklin bought Templeton funds.
Okay, no, but I want to know when Templeton's name, because it was Franklin Templeton.
After 92.
For so long.
Yeah.
For how long?
I think still now.
That's what I thought, but I wasn't sure because I don't follow that fund.
But John Templeton was managing the Templeton Fund.
Yeah, I just don't follow.
He was kind of like the Peter Lynch of his time period.
It is. Okay. All right. Okay. Phew. Man, I thought I was like... Okay, I didn't totally lose the game of financial trivia, mutual fund trivia. But yeah, so back to the point though. Yeah, I think that, and then of course, Janus funds.
Yep.
When you're dealing with technology companies, technology would have been taking up a huge portion of your portfolio in the late 90s. And if you weren't a rebalancer,
Janus 20 and some of those,
then you ended up in a situation with all of those huge, and so capital gains gains just means you made some money.
Yeah. I want to owe $1 million in taxes. That's my goal.
and part of the problem is when people are getting out of the funds can drop in value, but they're causing capital gains on the funds. So you're going to end up paying capital gains taxes after your portfolio was dropped in value.
Yeah, that's the frustration. I remember when they were toying around with changing that law, and I was doing radio, in those, it was literally in the early 2000s. And I was like, man, I really hope that they change this. I really hope that they change this. And of course they didn't. It was too profitable. We can't change that. We might lose some tax money.
Right.
But the beauty of it anyway, at this time, we don't know what's going to happen in the future. But if you're in 10 or 15% tax bracket, and that's a lot of people.
Oh, yeah.
Or 10 or 12% tax bracket, excuse me. You're in a 0% capital gains rate.
Right.
And you look at that and go, that's not terrible.
And those rate bands have shifted for inflation. The tax rates are the same. But now to get into the 20% capital gains rate, your taxable income has to be like $505,000 or something. So almost everybody's in a 15%
you've got to be in the top
gains rate.
Yeah, to get in the very top, that 20% rate. You have to
$500,000 plus.
Yeah, 583.
Yeah.
Right.
Paul, I remember when I started in this business, my dad said to me, well, I hope one day you're paying $50,000 a year in taxes. And I looked at him and said,
Are you crazy?
I was like, I never want to pay the government $50,000 a year in taxes. And he said, well, you have the wrong attitude. I'm like, why? He said, because if you're paying $50,000 a year in taxes, it means you're making enough money to have to pay them $50,000 a year in taxes. And I kind of changed my whole viewpoint of that. And when I was...
that's as opposed to if they raise the tax rate so high that even at a low income, you're paying that much in tax, then I still won't be happy.
Well, but I remember when I was teaching at Florida International University on a workshop called Successful Money Management, I used to say to the class, living in America, we have a blessing and a curse. The blessing is that it doesn't matter what side of the tracks you grew up on, what your gender is, and there were only two back then. I think it's still the same today. What the color of your skin is.
Yowza.
We all have the ability to get a free primary education, and we all have the same ability to go on and create wealth.
Yeah.
Okay? The curse is you have to pay taxes.
Yeah.
And being I was in Miami at the time, and then probably more than half of my students were of Latin descent.
Yeah.
I would say, well, it beats living in Cuba.
Yeah.
Or Venezuela. Or many of the other countries.
Although they still are driving this really cool 57 Chevys.
Yeah.
Are they still?
That weigh like 4,000 pounds.
But, are they still?
But the point is
they
that
don't rust down there, I don't think.
But I, as you had said earlier, I think the point is that too many people make their investment decisions based upon taxes, and that's the wrong reason to make them.
Right.
Yeah. Well, and if you look at what gets people to these dinner workshops, it's that topic. Because they think that that's the big deal, and the reality of it is it's not. The studies, as I've talked about, I mentioned last week, that one article that says, oh, surprise, the biggest deterrent or the biggest difference between you being successful or not is, managing the money, investing well.
Yep.
It's not, avoiding taxes. It's not, but it's important. It's part of the deal. It's part of financial planning.
Oh,
you want to be a good steward of whatever you've got, but don't overly focus on that one thing. And that is, it's typically what investment firms focus on because it's so stinking complicated that you will throw up your arms in disgust and be so confused.
Yeah.
And the reality of it is you'll call the investment firm for the wrong reason to help you around the tax code when they should be focusing on more academics.
Yeah.
In investing.
The only way that I know that is the only guaranteed way of I know to pay less taxes, just make less money.
That's it. That does it. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.